So hello everyone, my name is Lucas Krenn, and today I'm going to be presenting a trading strategy that I worked on in collaboration with HKML EduTech. As Gautier said, this is actually a very natural next presentation, as this is very much something that could be implemented in Darwin X. So before I begin, I'd just like to introduce myself a little bit further. So as I said, my name is Lucas Krenn. I was born and raised in Canada. I'm currently presenting out of Canada. And in my undergraduate degree, I went to a university called McMaster University, where I studied mathematics and statistics. And I was involved in what was called a co-op program. And that allowed me to take time off during the year to do a number of internships. And this was for credit. And so I was able to bounce around a few places in Toronto. I worked at large and small hedge funds. I worked at a pension fund, a bank's asset manager, and in many cases. And so I really got to sort of understand the geography of quant finance, at least in Toronto. I then went to the University of Toronto to do a master's degree. I got my master's in mathematical finance, and I graduated just about a month ago. And so now I'm on the full-time job hunt. And so if you or someone you know is looking to pick up some junior talent and you like what you see here, please let me know and I can shoot you a copy of my resume. So before I begin any presentation, I always like to talk about motivation. Like, why are we doing this? What's the point? Well, every year, publicly traded companies in America are asked by the Securities and Exchange Commission to file an annual report, otherwise known as a Form 10K. And in these 10Ks are a number there's a lot of information in these 10Ks, ranging from the nature of the business to financial reports, the health of the company, to risk factors, to management's opinion on the performance of the companies. And these will come in handy a little bit later. But as with any data set, we can sort of squeeze these to see if we can sort of extract any alpha from these papers. And so I came across a famous white paper that was called Lazy Prices, and I'll be sharing the link with that, the link to that with you guys a little bit later. But the gist is that when we're looking at these forms year over year of the same company, companies whose annual reports change drastically tend to have not fantastic stock results versus those that have more consistent and robust year over year reports. And so we're going to be taking this idea and we're going to see what we can do with it. This is already the first step of what I like to call the strategy pipeline, which is sort of the agenda for the day. And this is sort of the pipeline that I like to go through whenever I'm creating any sort of algorithmic trading strategy. And so we sort of already have step one. Sorry, I think somebody is unmuted. In any case, so we've already sort of seen step one, which is develop a hypothesis. And our hypothesis is to parse 10K documents to try to trade drastic or consistent changes in these 10Ks. And so to test our hypothesis, naturally, we're going to need data. And there's many different places that we can source data from. Naturally, since we're looking at Form 10Ks, which are submitted to the SEC, we can use their API, which is actually very, very user-friendly. And I found it very easy to work with. And if we're looking for price data or any sort of alternative data, naturally, we can turn to the Bloomberg terminal. If you don't have access to a Bloomberg terminal, Yahoo Finance is also a great resource for open, high, low, close data. And of course, you can always ask your friends at HKML to see if maybe they have the data that you're looking for. And that happened to be the case for this project. So once we have our data, we pass our data sets on to step three, and we use this data to try to generate a signal. And so I've listed three here. All three are equally valid, but today we're going to be going through one of them in particular, and that is cosine similarity. And once we sort of have our signal, we can use our signal to construct our portfolios. Again, a number of ways to construct portfolios. We'll be going through one such example today. And once we have our portfolios, then we can sort of analyze them to see whether or not it's actually worth implementing. So before we sort of step into the meat and potatoes of the presentation. I also wanted to point out that there's a few lessons to be learned that I wanted to share with some of the junior talent. And of course, if you have any questions, please feel free to put them into the chat. So we'll just jump into step one of the strategy pipeline, and that's develop a hypothesis. And so even sort of before we jump into anything quantitative, or even before I wanted to do any sort of analysis, I wanted to ensure that I understood exactly what a form 10K was. And so step one was to sort of go through a form from beginning to end and sort of gain a prior on exactly how these forms are laid out. And so I flipped through one, it was for American Airlines, and I sort of understood exactly how they're formatted, what to expect, and this sort of really helps me in the parsing process. And so the way that these forms are laid out is there's 15 items, 16 if you include the summary, and they're divided into 4 parts, as you see on the right-hand side. And if we're looking at any sort of sentiment, or if we're looking at drastic changes in textual information in the documents, there's really 2 items that really stick out, and that is risk factors and management's discussion and analysis. We're going to get a little bit more into that a little bit later, but those are the 2 that I think were most relevant on a first glance. And so we can step into the first lesson of this presentation, and that is remain as general as possible. So when I first started this, I knew that I was going to be presenting to the rest of HKML, and so I really wanted to flex sort of a little bit of my fundamental knowledge, just because I thought maybe it would gain me some brownie points, but it ultimately ended up hurting me. So the idea that I had was, if we're considering long-short portfolios, you kind of want a zero-sum game. And so if you're looking at something like a oligopoly in the sense that American Airlines in particular, the way that they behave is very similar to exactly that, an oligopoly. And so I figured perhaps we can use we can implement a long-short portfolio which trades very minute changes between these documents. And so I thought that perhaps this would be even better than looking at the market as a whole, but I ran into a lot of problems along the way because if you consider the American Airlines space to be a little bit of an oligopoly, then you would know that there really isn't too much data, right? We're only, over the past 20 years, I think I was able to only find about 23 individual US listed stocks that were publicly traded. And so that really didn't give us enough data to do any sort of analysis. And so I scrapped the idea and I moved on to looking at the general market. And so that moves us to step 2, which is create or obtain data sets. So this is the tricky part, in that when you're looking at sort of the greater market, it's very difficult to find point-in-time data of stock constituents. And so I was able to get the SEC data very easily, but it was the price action data that, or the returns data that was a little bit more difficult. So suppose we want to find point-in-time data of all the stocks that are listed in the S&P 500. If you want to find out exactly what stocks are in the S&P 500 right now, it's fairly easy. You can go onto Bloomberg and type in MEMB, and there it would list the constituents. But point in time is a lot more difficult. And so this is something that I would like to turn to the audience. If you know of any resources for amateur quants to find point in time constituent data of various indices, please let me know, because this is something that's a little bit difficult. And ultimately I had to ask my friends at HKML Edutech to help me out with. So they were nice enough to provide me with price data, and I had my SEC data, and so I was ready to sort of move on. And so this brings us to our next lesson, which is start with something simple. So because I was looking at the 2 items that I mentioned earlier, 1, risk factors, and item 7, management discussion and analysis, I really wanted to find a way to scrape this information from each of the documents. And this sounds a lot easier than it is. And so, like I said, I was presenting for HKML, and so I really wanted to try to find something fancy to use. And it turns out that that wasn't the case. So I was going through the documents and I tried a bunch of different methods. I tried using regular expressions to try to catch every instance of item 7, for example. And you can only imagine how that would turn out. Using regexp on HTML formatted documents is no good. And these documents in particular were a little tricky because they could be formatted as HTML or they could be just formatted as plain text. And so using a regular expression, a vanilla regular expression, was certainly not enough. And so I tried using something like Beautiful Soup, but again, it's a little bit tricky when the format of your data changes, right? So some forms were written in HTML, some were in plain text, and so it was a little bit difficult to get every case. And I ended up finding a little bit more of a novel way to be able to extract this information. So by parsing the document, the PDF document, and using sort of like a read lines, I was able to search for the first word of the sentence to see if a regexp that contained item 7 would be in that first word of the sentence. Now, this changes, or this varies from the previous strategy, because if I was just looking for matches of item 7, they could also appear somewhere in a paragraph, or they could appear in the middle of a sentence, for example, and that's obviously not a case that we want. We want the section header, and therefore it would be the first item of a sentence. And so by using sort of a read lines, checking the first word of the sentence to see if that matched the regexp, we were able to sort of get the information that we needed, and we could sort of move on to the analysis. And you can sort of see the chart on the right verifies that that we did in fact catch the correct sections, and we can see that actually over time the number of words gradually increases, which is something that's very interesting, that is also pointed out in the lazy prices paper that I mentioned. Where are we at right now? Well, we have our data, we have our returns data, we have our SEC data, and we're able to scrape our documents for whatever items we may need. And so now we can move on to the signal generation step. And this is a continuation of sort of the same lesson as I was mentioning earlier. Prior to this project, I was working on a different project which utilized a popular sentiment model called Finbert. And so I tried applying it to this problem as well to come up with a signal, but ultimately it took way too long for my slow laptop to analyze. And so I sort of had to scrap the idea in favor of a different signal, and that was also found in the lazy prices paper that I had mentioned earlier. And the signal is called cosine similarity. You can imagine how silly I felt when Gautier pointed out that perhaps I could have used something like Google Colab to do this project, but I guess I was too far invested in cosine similarity at this point that I sort of had to see it to the end, and perhaps now I can try to implement Finbert using Google Colab as a future project. So the idea still remains the same, and we can sort of use this measure to find a way to understand how drastically these documents have changed. And so we can still maintain that same idea that I mentioned earlier, that is short companies whose item 7s, whose contents of the item 7s change drastically. And we want to long the companies with few changes because that signals that they're a little bit more robust. And indeed, it sort of makes sense if you think about it. If we're looking at a section such as risk factors, if a company's risk factors are changing very much year over year, then perhaps we don't have a fantastic idea of what exactly their true risk factors are. Versus a company that's a little bit more robust, their document won't change so much. And so that's obviously a company that you want to be buying. So we'll now step into exactly what this cosine distance is and how it works and how we can use this to sort of score these documents. So suppose we have two sentences. We expect demand to increase and we expect worldwide demand to increase. So if DA is our first text and DB is our next year's text, we can already sort of get a fundamental idea that perhaps these sentences are quite similar. So the way that cosine similarity works is we take a superset of these sentences and we sort of create a corpus of words here. Naturally, that's after sort of cleaning the data, removing any sort of numbers or numerical entries, and also converting everything to lowercase. So we have our superset of words. And so we can sort of embed these sentences into vectors using this superset of words. And so when the word in the superset appears in our sentence, then we can assign it the number 1, the binary 1. And if it does not appear, then we can assign it a 0. And so if we're looking at the sentence, we expect demand to increase, the word worldwide does not appear in that sentence, and so it gets assigned a 0. And so that's how we're able to sort of embed these sentences and these documents into vectors. Now, if we want to come up with a score, then we can use the sum, then we can use exactly the formula here, which is the sum of the element-wise products of each vector divided by the magnitude of each vector, divided by the product of the magnitude of each vector, sorry. And that kind of gives us a score. And this score works extremely well because it's sort of bounded between 0 and 1, 1 being exactly the same, 0 being completely different. And so this naturally works fantastic for looking at sort of coming up with a signal to measure exactly how different the texts are. So we have our cosine similarities, and so we store them into a data frame, and then from there, we're sort of able to do further analysis. And that's sort of where we are right now in the project. So we have our signal, and so we're sort of ready to move on. So before we get into even further analysis, I wanted to introduce a concept called cluster demeaning. Now, naturally, when you think about stocks, you know that many times companies are clustered into sectors, right? We have tech stocks, energy stocks, there's all kinds of different sectors. And not all sectors are built the same, right? Not all business practices are exactly the same. And so it could very well be that a sector like utilities doesn't have so drastic changes because it's sort of a very well developed and very well understood industry with very slow, there isn't a whole lot of innovation versus something like tech. And so it could very well be that utilities as a sector will always score higher than tech. And we sort of want to get rid of this structural difference in sectors or any sort of way to cluster these stocks. And so that's sort of the next step is now that we have our signal, we want to remove these means from the signal so that every company has a level playing field. And so you may ask, like, how can we do this? Well, if you think about when I was mentioning the Form 10K, we know that item 1 is actually a description of the business. And so if we have a description of the business in textual form, we now know how to embed these descriptions into vectors. And from there, we can sort of develop a sense of closeness. We can sort of find a measure, and we can then decide when or how we can cluster these companies and then remove this mean from the signal such that, like I said, everybody has a nice, even playing field. So again, we take the superset of all of the words that we've cleaned, and then we can create an embedding containing the frequency of each word in the superset within the business description. And so, like I said, if we're looking at something like American Airlines, the word airline will show up pretty frequently in the business description, and so it gets a frequency of 50. Whereas perhaps the word poultry would not appear so frequently in the business description of an airline, and so perhaps it only shows up once or perhaps never. But this is just a toy example just to demonstrate this. And so we do this for each business description, for each 10K, and we sort of save this into a data frame. And so we have our vectors of our businesses. Now we can sort of get an idea or define a measure to understand how close these businesses are, and then we can sort of cluster them based on their closeness. So the way that we can do this is actually with hierarchical clustering. So by sort of fitting a dendrogram on these vectors, we're able to create, we're sort of able to rearrange these business descriptions, and more importantly, their pairwise distances between each other in such a way that we can start to see some natural clusters here. And so On the left is sort of the pairwise distances of each business description with other business descriptions. And here it just sort of looks like random noise. There really doesn't seem to be any sort of rhyme or reason to it. Whereas if we use our dendrogram method and rearrange the stocks such that the similarities of the pairwise distances are closer together, we can start to make out some natural clusters. There's obviously a very large one here. There's a very small one in the bottom corner. There's a cluster here. And then from there, we can sort of systematically assign clusters. Here's an example, n equals 20 clusters. And then from there, we can do exactly what we said before, that is demean the signal such that everybody has a level playing field. And so we saw that there was like this tiny, very strong cluster on the bottom left, and just for validations purposes, I decided to sort of look into what these companies were that were clustered so tightly, and you can sort of get an idea that yes, indeed, this seems to work pretty effectively in that pharma or biotech companies were clustered very, very close together, and so now we sort of have the demeaned scores that we can remove from our cosine similarities that we had earlier. And so from here, we can start to sort of gain an insights into whether or not this is an idea that's worth pursuing. So we have our cosine distances, and we have sort of our cluster means for each stock. And so when we're looking at trading strategies, we want to know if they're effective. And so there's the easiest way to do this is to sort of rank the scores of each stock according to their magnitudes, and then compare it to the rank of the returns. And so we take the rank of our scores and find the correlation to the rank of our returns. And if we see some sort of correlation, then perhaps this is an idea that's worth pursuing. And so I did this for 2 cases. Well, technically I did it for 4 cases, but I'll show you what I mean in the next slide. So we sort of have 4 lines here showing the correlation of the signal to ranked returns. And so there really is 2 very promising lines here and 2 perhaps not so promising lines here. And so naturally I wanted to look at sort of the easier way initially, and that was looking at item 7, which is management's discussion. And that sort of had okay results. Oh geez, I noticed that my blinds are sort of in the way. That's fine. Where did I leave off here? So I was looking at item 7 only, and that had okay results. And then I decided to include items 1A and 7. And from there, I was sort of able to see that perhaps including more data means that the signal gets a little bit stronger. And so I tried looking at the whole document, calculating the cosine similarities of the whole document. And that was even more promising. And so from there, I did the cluster demeaning, and once again looked at the correlations, and those were strong as well. And in fact, you can see that the signal correlates higher to returns when we look at sort of returns over a longer period versus shorter. And we can see naturally that perhaps using this cluster demeaning strategy is actually worthwhile. And so this sort of brings us to the next lesson, and that is have some patience. So with this chart, we're looking sort of at the correlation of ranked scores to ranked returns over certain periods. And so it's important to point out that not every quantitative strategy is in fact high frequency or intraday, or has to be some fast algorithm. And in some cases, you sort of need to wait to see results. And so we actually saw the highest correlation of our best score by waiting and seeing the returns over 240 days versus a short term, let's say a week or even sort of a month. So this actually plays to our benefit because we won't see too many transaction costs if we're rebalancing once a year, for example. And so this was sort of like another lesson that I wanted to share was perhaps Not every strategy needs to be super fancy, super fast, and sometimes patience is what's required for these strategies. So now we sort of understand that we have our signal, we understand that perhaps these signals are quite promising, and so we can sort of move on to the next step, which is portfolio construction. And so the way that we can construct our portfolios is now we sort of have our cosine similarity scores, and we sort of have our cosine similarity scores with the sector demeaned, and we're going to be taking a look at both portfolios. So we can use what is called a probability integral transform to turn our ranked cosine scores into a long-short portfolio with weights that sort of sum to 0. And it turns out that using this does in fact give us some very, very nice statistical properties. So this transformation is very simple. So we have our score here, which is our cosine similarities with and without the sector or the cluster removed. We rank our scores just like what we did with the correlations along the rows. We subtract 1/2 from those scores, divide divide each of these scores by the count of the number of scores in each row or each date. Then we multiply by 2 and subtract 1. This gives us the nice statistical properties of our portfolio that we see on the left here, in that our predictors or our weights are sort of uniformly distributed -1, 1 random variables, and the sum of these predictors sums to 0. So we have our weights, and now we can sort of move on to the final step, which is to look at the equity lines, plot our equity lines, and understand whether or not this is actually worth pursuing in the end. And we quickly find out that the results are actually fairly promising. So if we look over approximately a 20-year period, we get pretty decent results. And now this is using 5 times leverage on the strategy, which is fairly common among hedge funds for long-short strategies. But like I said, we can see that the P&L is quite promising, giving us a 300% return over approximately 20 years, which gives us about a 6% or a 5% return, depending on which way you wanted to create your signal. So it turns out that the demeaning method actually helps us a little bit in getting a little bit more returns, and it increases our Sharpe ratio to something that's actually quite favorable. And so we can definitely see some outperformance using the cluster demeaning strategy versus non-cluster demeaning strategy. And we can also see that the drawdowns are okay, pretty favorable if we're considering the fact that this is sort of like the first implementation with no sort of optimizations involved. And so we can sort of move on to some analysis of the portfolio volatility, and we can see that sort of on a rolling 1-year basis, our demeaned strategy actually has slightly higher volatility, which is a little bit interesting to think about. But the difference in average volatilities is actually a little bit worth the sacrifice of getting approximately an extra 100 points onto our return. And so we can really see that perhaps the demean strategy is a little bit more favorable versus just the vanilla strategy. And we can sort of understand, we can look at as well the turnover of our portfolios and see that when we look at the frequency at which companies, or rather the dates in which companies report their 10Ks, we can see that they're very timely, and they tend to occur sort of at the end of Q1 of each year, and that's exactly what these spikes are. And so this is extremely favorable if we're looking at coming up with a deployment portfolio, or something that we want to put into Darwin X, for example, because we know that turnover will be super low, and we can sort of trade these or rebalance these portfolios only once a year. And so T costs become a little bit less relevant than, for example, a high frequency trading strategy. And so ultimately, this sort of wraps up the analysis of what I have so far. But naturally, there's some next steps that I wanted to add in. And of course, there's a few scores that I wanted to try besides just cosine similarity, which I think would be very powerful. There's different ways that we can sort of embed our clusters such that we can perhaps score even higher, versus just doing word frequency, for example, and turning that into a vector. There's different ways to optimize our portfolios. We can sort of include real world scenarios. So like I said, T costs, slippage, perhaps not so relevant, but still something that you want to, that we want to include into our portfolios. And like I said, even perhaps implementing Darwin X. So that sort of wraps up the project thus far. And so I just wanted to say thank you to everyone at HKML. I'm sort of a new joiner, and everybody's been extremely friendly, very welcoming, and so I want to thank everybody for that. And I want to thank the folks at HKML EduTech, because you know, they gave me this project to work on. They said I could present it, and so if you're sort of young talent in the machine learning space and you want to get into finance, or you have some curiosity about quant finance, HKML is the place to reach out to. They have tons of resources. Everybody's always willing to pick up the phone and chat with you and help out with your projects. And of course, if you want to do a project similar to this, they would also be more than happy, I'm sure, to help you out. So that concludes my presentation. And like I said, I just want to thank everybody for the opportunity.